What you're about to hear isn't noise, and it isn't just another market update competing for your attention. It's a moment that's unfolding in real time, one that carries weight far beyond a single trading session or a temporary spike in volatility. While most headlines will focus on stock charts and percentage moves, something far more consequential is ticking quietly beneath the surface, and the clock on it is running down fast. Over the weekend, a geopolitical line was drawn with unusual clarity. A 48-hour ultimatum was issued, and that window is now nearly closed. The implications of what happens next are not abstract. They are immediate, structural, and deeply tied to the foundation of global energy flows, financial stability, and ultimately, the purchasing power of money itself. The kind of moment that doesn't just influence markets, it reshapes them. At first glance, the numbers don't seem alarming. Silver is trading in the high 60s, up modestly on the day. Gold is slightly down from earlier highs. To the casual observer, it looks like a normal, perhaps even uneventful session. But beneath that surface is a different story entirely. The intraday swings alone tell you this is not a calm market. Silver moving nearly $9 within a single session, and gold swinging hundreds of dollars, and is not routine fluctuation. It's stress. It's pressure being released in unpredictable bursts, and that pressure is coming from somewhere specific. It's not a collapse in the fundamental value of these metals. It's not a sudden oversupply. What you're seeing is forced selling. Large institutions, hedge funds, and leveraged players are liquidating positions, not because they want to, but because they have to. Losses elsewhere in their portfolios are forcing them to raise cash, and the easiest assets to sell are often the ones that have gone up the most. Gold and silver, after strong runs, become liquidity sources. That creates a contradiction that is critical to understand. The price you see on the screen is not always a reflection of true value. In moments like this, it's a reflection of urgency. It's what someone is willing to accept when they need immediate cash. Meanwhile, the physical reality, the actual metal sitting in vaults, the supply chains that produce it, the industrial demand that consumes it, remains unchanged. That gap between paper pricing and physical reality doesn't persist forever. It resolves, and when it does, it tends to do so abruptly. Now layer on the broader context. This isn't happening in isolation. The global energy system is under strain in a way that is both immediate and long-lasting. Key production capacity has already been damaged, and not in a way that can be quickly repaired. We're not talking about temporary disruptions measured in days or weeks. We're talking about years. When a significant portion of natural gas production is taken offline for multiple years, the ripple effects extend far beyond energy markets. Natural gas isn't just fuel, it's a critical input in fertilizer production. Fertilizer, in turn, is foundational to global food supply. When you disrupt both the raw materials and the processing capacity at the same time, you create a compound effect. It's not just an energy shock, it's a food shock in the making. And unlike financial markets, which can react instantly, food supply chains operate on seasonal cycles. The consequences show up with a lag, but when they do, they hit directly at the consumer level. At the same time, financial markets themselves are showing signs of structural weakness. Major equity indices have broken below their long-term support levels, something that doesn't happen often without signaling deeper issues. These are not minor technical events. When the largest indices in the world fall below their 200-day moving averages after extended periods of high valuation, it suggests that the trend is changing, and not just temporarily. Bond markets are also under pressure. Yields are rising, which might sound positive at first glance, but in this context, it signals selling. Investors are moving out of bonds, pushing prices down and yields up. For a government carrying an enormous debt load, rising yields translate directly into higher borrowing costs. That's not a theoretical problem, it's arithmetic. Every increase in interest rates adds to the burden of servicing existing debt. There comes a point where that burden becomes self-reinforcing. Higher yields increase costs, which require more borrowing, which in turn can push yields even higher. It's a cycle that policymakers are acutely aware of, and historically, there's only one politically viable way to break it: increase liquidity. In simpler terms, print more money. That's where the story starts to converge, because while markets are dealing with forced selling and geopolitical uncertainty, monetary policy is quietly shifting in the background. Balance sheets are expanding again, liquidity is being added, and yet inflation pressures are already building. Producer prices have been rising faster than expected, even before the latest energy disruptions fully worked their way through the system. So you have a situation where inflation is accelerating, supply chains are under stress, and the monetary response is leaning toward expansion rather than restraint. That combination has a well-documented outcome. It erodes the purchasing power of currency, not overnight, but steadily, and then suddenly. What makes this moment particularly unique is that the traditional mechanisms that might counterbalance this dynamic are not functioning as expected. The idea that higher interest rates can suppress inflation is challenged when those rates threaten the stability of the debt itself. The notion that the dollar strengthens during times of crisis is less reliable when confidence in long-term value begins to erode, and the belief that equities will continue to generate wealth is harder to sustain when valuations are already stretched and technical support has broken. When those pillars weaken simultaneously, the market begins to search for alternatives. Historically, that's where hard assets come into focus. Not because they are perfect, but because they don't rely on a counterparty. They don't depend on policy decisions or balance sheet adjustments. They simply exist, with a finite supply and a long history of retaining value across different economic regimes. But even within that shift, the path is not linear. As we're seeing now, the initial phase of a broader transition can involve selling across all asset classes. Liquidity events don't discriminate. They pull everything down together. It's only after that phase exhausts itself that differentiation begins. That's when assets that are fundamentally strong start to separate from those that are structurally vulnerable. The timing of that shift is never exact, but the indicators are there for those watching closely. Oversold technical conditions, compressed premiums in physical markets, and increasing divergence between paper prices and real-world demand all point to a setup that has historically preceded sharp reversals. And all of this is unfolding against the backdrop of a ticking geopolitical clock. Within hours, a decision point will be reached. Whether it results in escalation or de-escalation, the structural realities already in motion don't simply disappear. Damage that has been done remains done. Supply that has been lost doesn't instantly return. The inflationary pressures that are building don't reverse overnight. So the question becomes less about predicting a single outcome and more about understanding the range of consequences. If escalation occurs, energy markets could enter a more severe phase, with direct implications for inflation and global trade. If it doesn't, there may be a temporary sense of relief, a rally in risk assets, a pause in volatility. But the underlying issues, supply constraints, monetary expansion, structural imbalances, remain. That's the part that often gets overlooked. Markets react quickly to headlines, but they adjust slowly to structural change. And right now, the structural change is significant. It's not just about one region or one commodity. It's about the interconnected system that links energy, food, finance, and currency together. In that system, timing matters, sequence matters. Watching how different indicators move in relation to each other provides clues about what comes next. If yields continue to rise while equities struggle, it suggests stress is spreading. If the currency fails to strengthen during uncertainty, it signals shifting confidence. If precious metals remain under pressure despite supportive fundamentals, it points to ongoing liquidation, but also to potential opportunity once that phase ends. Ultimately, this isn't about reacting to fear or chasing momentum. It's about recognizing the environment you're in and positioning accordingly. Every period of instability creates both risk and opportunity. The difference lies in understanding which is which. Moments like this don't come with clear labels. They don't announce themselves as turning points in real time. They feel chaotic, uncertain, even contradictory. Prices move in ways that don't seem to make sense. Narratives shift quickly, and yet, beneath that noise, there's a pattern, a sequence that has played out in different forms throughout history. Debt reaches levels that strain the system. External shocks amplify existing weaknesses. Monetary policy shifts toward accommodation. Inflation rises. And eventually, assets that preserve purchasing power begin to reprice in response. That process isn't smooth. It involves volatility, false starts, and periods of doubt. But the direction, once established, tends to persist. So, as the clock continues to tick and the next phase unfolds, the most important question isn't just what happens in the next few hours. It's how the pieces already in motion come together over the coming weeks and months. Because by the time the narrative becomes clear, the opportunity it created is often already behind us. Right now, we are still in that early phase, where signals are aligning but outcomes are not yet fully visible, where markets are reacting but not yet fully adjusting, and where those paying close attention have the chance to see the bigger picture before it becomes obvious to everyone else.